はい、今日はニューヨークのですね JP モルガンさんの、本社に来ています。今日は JP モルガンアセットマネジメントのお三方に、インタビューを行っていきたいと思います。それでは行ってまいります。
The way we think about products and innovation is trying to find a way to partner with investors. It's always by listening to our clients. Everyone likes income, everyone likes having less volatility and risk, and everyone likes high quality, good companies. And that's why we created that strategy. And the other thing clients were challenged with was, if you're an income-oriented investor, you don't probably have a lot of growth in tech in your portfolio. So the fact is, we said, what if we could put three phrases together that very rarely do clients put together? Tech and growth, less risk, and income. And that's kind of where JEPQ got its start. So when I think about using options in a portfolio, a couple things I would say. Number one, I don't believe in leverage. Leverage to me is a third rail. You get income, but that income is not free. Through a cycle, you may give up some of the upside of the market in return for getting that income today. Options actually lower volatility and beta to your equity portfolio. So it actually lowers the risk through a cycle. And the other thing I'd say is when you add options to deliver the income, you're not dependent upon central banks. You're not dependent upon the yield curve. You're not concerned about duration risk, and you're not worried about credit spread risk. So it gives you that added benefit that some of those other asset classes you have to be considerate of. People use these income-oriented option ETFs as a cornerstone of their income portfolio. But we also see people using them as a more conservative way of getting equity market exposure. These strategies fit in very nicely into portfolios. And then lastly, you can actually replace some of your equity with it, but there's a nice way to complement a traditional portfolio with these strategies. And I think that's why they really have taken off. AI is real. We had a couple things in our stable. We had 40 years of every analyst write-up, earnings revision. We had 40 years of every portfolio manager's trade. And we were able to build and train our own AI process using our own data. So it's going to be less than 100 basis points. As we expected to deliver annualized 9 to 11% distributable income, I would say that means somewhere between 8 to 10 is going to be options premium. Volatility tends to be the enemy of investors' portfolios. What's really nice with our approach with JEPQ, and JEPQ for that matter, is higher volatility is a friend. When volatility goes up, options get more expensive. I'm going to give you more income. And the income that we pay out each and every month, it's 100% of my dividends and 100% of my options premium. I don't save anything for a rainy day. As an investor this month, you've earned that with me, and I'm going to give it to you. Many of my competitors don't actually own their own strategies, which blows my mind away because you want somebody else to buy your strategy and you don't own it. Pretty crazy. But when I think about the differentiators, number one, we're active. Most of our competitors are not active. Number two, we've always believed that we have a best-in-class product, but we never wanted fees to get in the way of our strategies. We don't want to be the low-cost provider, but we don't want anyone to say, nope, I'm not buying that strategy because the fees are too high. And I think our fees are probably some of the lowest in the industry, intentionally. JEPQ we launched on May 4th of 2022 here in the US, intentionally May 4th. I'm a Star Wars geek. May the 4th be with you. And when I think about going forward, I think growth in tech stocks tend to be pretty good. I think it's going to be more modest. And in a more modest rally, I think our dividends, our options premium, and some of the upside should do just well, just fine. What would be a challenge for us not to be able to deliver 9 to 11? It would probably be if the NASDAQ VIX, there's actually something, that's the NASDAQ VIX, is the VXN. If that were to go to very, very low levels, it potentially can go below that 9. The VIX is actually a measurement of uncertainty. And given where we are today, there's a lot of things in the world to be uncertain about. There's enough to be uncertain about. So I kind of think that volatility is going to be at its long-term average, maybe even slightly higher based upon the uncertainties we see in the world. And with that average level of volatility, we should be okay with the distributions in JEPQ. So what I would say is this. Thank you for investing in one of my kids.
We are very excited to be here with Mr. Hamilton Reiner, who leads the portfolio manager team for JEPQ. Thank you for having me, Hamilton.
It's so nice to be here with you. Thank you. My name is Hamilton Reiner. I've been investing in equity and equity options for over 37 years. My current role I have three different individual roles. They're all kind of associated. The first one is I'm the lead portfolio manager on our option-oriented strategies. The second one is I'm head of derivatives for U.S. equity asset management. And then lastly, I'm the CIO for our U.S. core equity platform. All of them are highly related and all kind of fun in their own way.
You're the portfolio manager team for JEPQ. So I'd like to ask about JEPQ. JPI ETF was launched in 2020 and JEPQ in 2022. How did the idea for these covered call strategy ETFs originate, and what are the investment objectives and missions of JPI and JEPQ?
The way we think about products and innovation is trying to find a way to partner with investors. It's never been, I think it's cool, I hope somebody else does. It's always been by listening to our clients. And if you harken back to 2018, 2019, there really wasn't any income in fixed income. And investors like income. So given my background in options and in equities, we felt as though we could deliver income on an equity-associated portfolio. So the first strategy that we launched was Jepq. And Jepq was about delivering income, 7 to 9% distributable income paid out monthly over a high quality group of US stocks. And lastly, having less volatility in beta than the overall market. So when you think about those three things, those are kind of evergreen. Everyone likes income, everyone likes having less volatility and risk, and everyone likes high quality, good companies.
Exactly.
And that's why we created that strategy. But with the success that we had in Jepq, we said, what other things are clients challenged with? And the other thing clients were challenged with was, if you're an income-oriented investor, you don't probably have a lot of growth in tech in your portfolio because they don't pay dividends. And they're not in the high yield market. So the fact is, we said, what if we could put three phrases together that very rarely do clients put together? Tech and growth, less risk, and income. And that's kind of where Jepq got its start. It's a growth in tech equity portfolio. It's going to have about 25% less volatility and risk than the market, and we expect to deliver 9 to 11% distributable income monthly. And so given its uniqueness and its way to help round out investors' portfolios, it really has seen a fair amount of success.
In your view, what is the most significant benefit for investors when incorporating options into their portfolios compared to traditional investment methods?
So when I think about using options in a portfolio, a couple things I would say. Number one, I don't believe in leverage. Leverage to me is a third rail. I don't believe in it personally or professionally. I don't shun other people that do it, but for me, it's not something I want to do for myself or for my clients. So when you add options to a portfolio in an unlevered manner, you actually get two benefits. The first one's, I don't want to say easy, but it's more obvious. You get income, but that income is not free. Through a cycle, you may give up some of the upside of the market in return for getting that income today. But the second benefit, which I said is a little bit underappreciated, options actually lower volatility and beta to your equity portfolio. So it actually lowers the risk through a cycle. Now, when you put all of that together, I think it's a special sauce. But I'll add something else. And the other thing I'd say is when you add options to deliver the income, you're not dependent upon central banks. You're not dependent upon the yield curve. You're not concerned about duration risk, and you're not worried about credit spread risk. So it gives you that added benefit that some of those other asset classes you have to be considerate of.
How did covered call strategy ETFs like JPI and JPQ grow so rapidly and create a new trend in the active ETF market? I find this phenomenon truly astonishing. Could you share the background and development process?
You and me both. I never really thought when I launched Jepq and Jepq
really?
that they would become as big as they are. And that's not why we launched them. We really launched them because we felt as though clients needed income in an income challenged world. And so that's how we thought about it. As far as their growth, I think one of the reasons they've grown quite well is here at JP Morgan, we not only manage these strategies, I think we do a pretty good job of helping people understand where they fit into a portfolio. So in many cases, people use these income-oriented option ETFs as a cornerstone of their income portfolio. But we also see people using them as a more conservative way of getting equity market exposure, because we're going to give you some dividends, some options premium, and then some of the upside. As I said earlier, you may give up some of the upside to get that income today. So it gives you a nice balance of ways of getting return in a flat or even up market. And then lastly, In a world in which credit spreads are at near all-time tights, in a world in which people are very worried about duration on whether to be long it, flat it, or short it, and you eliminate those concerns from investors, these strategies fit in very nicely into portfolios. And then lastly, you can actually replace some of your equity with it. You can replace some of your fixed income with it, or you can replace some of your equity and fixed income with it. So in that portfolio construction, they don't do everything, but there's a nice way to complement a traditional portfolio with these strategies. And I think that's why they really have taken off.
While you talked that you didn't see this coming, when designing these products, what type of investors did you have in mind? Also, what do you think are the key factors that attract investors to these products overlap?
When I think about what attracts investors to these products, at least the way we design them, for years people did option overlay strategies, but it was just about the income. We really believed that it wasn't just about the income, it was about the income and some of the upside. We kind of want to have a little bit of our cake and eat it too. And I think that was one differentiator. The second differentiator, I believe, was having my history of investing in equity and equity options. There were many things I saw and did that I said, that was really good, let's do more of that. And there's many things I saw and did, and I said, nope, let's never do that again. So we were able to build these strategies from the bottom up. And part of that bottom up approach was actually the fact that we are an active manager. We're one of the very few active managers or strategies that actually do options on top of an active strategy. And that's kind of a lot of the secret sauce of JP Morgan US Equities is that we have these wonderful analysts that are career analysts that do an incredible job of talking to companies and identifying opportunities. We just don't buy the index and do options. We want to give people a better equity experience, some of the upside, and a fair amount of income.
I'd like to delve in deeper into the structure of JEPQ. How do you decide which stocks to include in JEPQ? You said they're very good active fund managers. Please tell us about the applied data science approach.
AI is real. There's a lot of headlines that say, AI, we're not seeing how people are using it, but all these people are spending money. AI is real. I mean, whether you look at your Amazon account, your Meta account, your Insta account, it is very obvious that AI is real.
Yes.
And when we thought about building an equity portfolio for JEPQ, we had a couple things in our stable. Number one, we had 40 years of every analyst write-up, earnings revision. We had 40 years of every portfolio manager's trade. And we were able to build and train our own AI process using our own data. It's not going to do anything fun like being able to put someone's head on someone else's body. It's not going to be able to write songs or poetry. It just does one thing. It actually thinks like an analyst to build a model on every single company, over 3,000 companies nightly. Constructing that view and opinion on a stock, utilizing right now over 50,000 data sources in 90 countries and 40 languages. So imagine if you and I were building a firm filled with analysts. How many analysts would I need to have to be able to consume 50,000 data sources in 90 countries and 40 languages? Wow. That's the power of AI. And because we trained it to think like an analyst, just like any other analyst, it gets smarter the more information it consumes. Just like any other analyst, when it sees something good and does it works well, you do a little more of it. So we actually have this ability, being here at JP Morgan, to have access to information. Now, it's never going to be machines gone wild because everything gets reviewed by a portfolio manager. But the power of having the ability to consume all that information and forecast out financial information, revenues, expenses, earnings on over 3,000 companies, real time, pretty powerful. So we think that that stock selection process and portfolio construction process is truly state-of-the-art and a differentiator.
Next question is, how is premium income generated through JEPQ's covered call strategy? Please share about premium income strategy.
So when I think about the income associated with JEPQ, some of it's going to be dividends, but growth and tech stocks don't pay a lot in dividends, so it's going to be less than 100 basis points. As we expected to deliver annualized 9 to 11% distributable income, I would say that means somewhere between 8 to 10 is going to be options premium. But just selling options is not good enough for us. There are other ways in which we think about which options we sell and how we do that. So let me bring that to life. The first thing is, as I said earlier, we always want to give you some of the upside, which means we're going to sell an option that's out of the money. What that means is the market's trading at 100, we're going to sell an option at 103, maybe higher, maybe a little bit lower, but always giving you some of the upside. The options that we sell are going to be just over a month in duration. That way we have the ability to constantly be selling new ones. But then there's this last thing, and it's a lot more work, but totally worth it. Imagine if the market was trading at 100, using that example, and then a week later, the market was at 105. What do? Do you buy back that old option, lock in a loss? Do you tell your investors there's no more upside for the next 3 weeks? Neither one of those are good outcomes. So we do 20% of our option every week. So this week 20%, next week 20%. So over time they're laddered and staggered. That way every week 20% are coming off and 20% are going on, but we still have 100% of the portfolio covered. That way when the upwardly biased market, when the market goes up, we're going to sell options farther out. And then lastly, volatility tends to be the enemy of investors' portfolios. When markets become more volatile, stocks go down, credit spreads widen, and there's turmoil in many clients' portfolios. What's really nice with our approach with JEPQ, and Jepq for that matter, is higher volatility is a friend. When volatility goes up, options get more expensive. I'm going to give you more income. When volatility goes up, I'm also going to sell an option that's farther away from where we are today, giving you a more potential upside. So volatility is a friend, giving you more potential income and more potential upside. It's a nice complement to the other wonderful things investors do in their portfolios.
So these products can deal with both sides of the environment, right?
Absolutely. And the income that we pay out each and every month, it's 100% of my dividends and 100% of my options premium. I don't save anything for a rainy day. As an investor this month, you've earned that with me, and I'm going to give it to you. So that income may vary a little bit, but still going to be a healthy amount of income.
I'd like to ask about the differences between JEPQ and other same type of products. So recently, many new covered call strategy products have appeared on the market, but JEPQ and JEPI still account for a large part of derivative income ETF market. So what are the main differences between JP Morgan's covered call ETFs and other products on the market?
The first thing I would say is the way you introduced the question, which is JP Morgan. I think JP Morgan as a starting point invokes trust and confidence in our investors. I mean, we are the gold standard, largest bank in the world, and I think clients trust us. That's number one. The second thing is I believe clients trust the investment team because we're one of the very few asset managers that do this type of strategy that actually own our own strategies. 90% of my personal assets are in the strategies that I manage. Imagine owning a strategy where even the portfolio manager does not own it. Many of my competitors don't actually own their own strategies, which blows my mind away because you want somebody else to buy your strategy and you don't own it. Pretty crazy. But when I think about the differentiators, number one, we're active. Most of our competitors are not active. Number two, we've always believed that we have a best-in-class product, but we never wanted fees to get in the way of our strategies. We don't want to be the low-cost provider, but we don't want anyone to say, nope, I'm not buying that strategy because the fees are too high. And I think our fees are probably some of the lowest in the industry, intentionally. We don't want that to get in the way. The third thing I would say is not only are we the largest, we've been doing it longer than anybody else. And we've seen up markets, down markets, sideways markets. So people don't have to say, I hope it does this if the market sells up. They've seen it. Jepq's been around since 2020. 2022, you saw how it did. 2021, 2023, 2024, 2025. Jepq we launched on May 4th of 2022 here in the US. Intentionally May 4th. I'm a Star Wars geek. May the 4th be with you. And so when I think about Jepq, from May 4th to the end of the year, the NASDAQ was down. You saw how the strategy performed. The market ripped in 23, up a lot. And then again in 24, and then modestly this year in 25, and you had a chance to see it. So I think the reason we are the largest strategies are, number one, we're JP Morgan, number two, we're active, number three, people have seen how these strategies have performed in up, down, sideways markets, and then lastly, I think our teams, whether it be the investment teams, the investment specialist teams, our client advisors, I don't think anyone does as good a job as we do at helping people understand how to use the strategies, where they fit in portfolios, where to fund them. And the other thing we always tell clients, this type of environment would be a good environment. This type of environment may be a little more challenging. We want to tell people what the more challenging environment would be because we don't want any surprises. I want people to own my strategies, be happy with my strategies, and not be surprised. And we actually talk about all of that in discussing these strategies with a client.
There are many reasons to be that top.
I'm very lucky to be here at J.P. Morgan with the best team in the industry.
From the perspective of a portfolio manager, what is your outlook for JEPQ going forward?
What I would say is 2022 was a challenging environment for growth in tech
Yes.
stocks. 2023 was an incredible year for growth in tech stocks. 2024 was, I would call it, a very good year, but not the same. So let's talk about 23 for a second. The NASDAQ was up 55%, one-way freight train. It went straight up, didn't stop, just went straight up. 24, it went up about 25%, but it was nearly 26%, excuse me. It went up, moved around a little bit, went up, bounced around. It was a little bit more of it was a good rally, but it wasn't just straight up. There was ups, downs, what have you. This year, pretty crazy. Not everyone remembers on Liberation Day in April. NASDAQ is up, I think, about 45% from the bottom. So given where we are today, just up over 20%, I think that's some incredible rally that we've seen in the NASDAQ. And when I think about going forward, I think growth in tech stocks tend to be pretty good. I think earnings on growth in tech stocks should be pretty good. But I don't know if we're going to have another 2023 55%. I think it's going to be more modest. And in a more modest rally, I think our dividends, our options premium, and some of the upside should do just fine. Now, the one thing is I don't have a crystal ball, but what I like about a strategy like JEPQ is it can work in multiple environments. In an up market, we're not going to keep up because we may give some of the upside for that income, but we should do pretty darn well. If the market sells off, the stock selection, the options premium should help us to the downside, lose less. But what if we end up in that range-bound market, that bouncing on range-bound market? You're still going to get a fair amount of those dividends and options premium. So I kind of think right now JEPQ really can be a good allocation when you think about how it could participate in a variety of different markets. Once again, not to replace your equities in your portfolio, but to complement them.
I receive frequently the questions from Japanese investors because Rakuten JEPQ is available now in Japan. Wonder whether you can maintain high income in the future because this product has little track since 2022. How do you usually describe the possibility of maintaining high income?
So what I would say is the first thing I'd say is when we talk to people about the goal of the strategy of 9 to 11% distributable income paid out monthly, notice I said the word goal. And the reason I said goal is because when a strategy, not ours, but a strategy has a target, it means they are prone to do something irrational at the wrong time just to deliver that target. And unfortunately, it never works out well. And so when I think about that goal, what would be a challenge for us not to be able to deliver 9 to 11? It would probably be if the NASDAQ VIX, there's actually something that's the NASDAQ VIX, it's the VXN. If that were to go to very, very low levels, it potentially can go below that 9, but low volatility is actually very infrequent. And when I think back to 2017, for example, with JEPI, the VIX was 9 and change for about 30% of the time. And even then, a strategy like JEPQ would have been able to deliver, we weren't managing back then, would have been able to deliver 6 and change. So if we were to have a challenging environment for volatility, it would be implied volatility go very, very low. Maybe the distributions for a short period of time would start with an 8. But I'm pretty confident, I can't promise anything, that 9 to 11 is pretty good. Now, the last thing I would say for our listeners is volatility is not about fear. Many times people go on TV or on blogs or online and they talk about the VIX being the fear index. It's not about fear. The VIX is actually a measurement of uncertainty. And given where we are today, there's a lot of things in the world to be uncertain about. Geopolitical, political, earnings, AI, credit spreads, recession, you name it, there's enough to be uncertain about. So I kind of think that volatility is going to be at its long-term average, maybe even slightly higher based upon the uncertainties we see in the world. And with that average level of volatility, we should be okay with the distributions in JEPQ.
People need income, people love income, but this product can't offer upside return. do you usually explain that disadvantage of this product?
When I think about the income associated with it, the income is going to be healthy. People are usually pretty happy with us. But I want to also, over time, have my net asset value go higher. And the way your net asset value would go higher is with some participation in the upside. So when I hearken back to JEPQ in the US, we launched it on, as I said, May 4th of 2022. And these are going to be approximate numbers, but directionally pretty close. From that day to the end of 22, the NASDAQ was down just under 16%, and we were down just about 11%, plus or minus a little. So we had less downside than the market, and we had a healthy amount of income. But then you have a year like 2023 where the NASDAQ was up over 55%, and our strategy was up over 36%. But of the 36% that it was up, the income was in the low teens. So that meant somewhere between 24 and 25% of price appreciation. And then you could talk about 2024, in which the market was up 26 or so percent, and we were just up just under 25. In that environment, the distribution was, once again, in the low teens. Let's call it 10-ish. So that means approximately 14 to 15% of capital appreciation. So these strategies, yes, I want you to have a healthy amount of income, but I also want to give you some of the upside. So I think when I think about a income-oriented investor, takes the income, but I also want you to have some capital appreciation as well.
Thank you. I deeply understand.
Awesome.
Lastly, to wrap up, I'm very excited to share that JEPQ is becoming popular in Japan. Please leave a message for Japanese investors.
So what I would say is this. Thank you for investing in one of my kids. These strategies, I was lucky enough to design, architect, launch, and I have 3 actual kids, and I have a couple kids with J.P. Morgan that my kids that I actually have know about, and I appreciate your partnership. I appreciate your confidence and trust, and I take none of that lightly. As I said, I invest my own money in these strategies, and I look forward to partnering with you in these strategies.
Thank you again for having me, Hamilton.
No, thank you. This was wonderful. Thank you for having me. Very nice to meet you.
Thank you so much. Very nice to meet you.
Thank you.
Thank you.
Right. Yeah, so I've been excited for this for a while.
Thank you very much.
And if you decide if you decide you want to ask me a different question that's on the list, ask me whatever you want.
Okay, thank you. Thank you.
I'm not sure I'm good, but I'll answer you at least.
I maybe ask additional questions.
Yeah, you could ask whatever you want.
Thank
Truly, I'm totally happy for you to go, off script or whatever you want to do.
Thank you so much.
Thank you.
So, can we start?
Sure.
Okay, thank you.